Credit risk is an important facet of risk management, especially in the financial sector. It refers to the possible loss a lender or investor may face if a borrower or counterparty fails to meet their financial obligations. Credit risk originates from the chance of borrowers defaulting or failing to pay, as well as changes in their creditworthiness over time. Understanding and managing credit risk is critical for financial institutions such as banks, credit card firms, and lending institutions, as well as for investors and individuals that offer credit to counterparties. Organizations can minimize possible losses and preserve a healthy financial position by appropriately assessing and minimizing credit risk. Default risk. This is the likelihood that a borrower or counterparty may fail to meet their contractual commitments, such as loan repayment or interest payments. The borrower's financial health, credit history, industry conditions, and macroeconomic factors can all influence default risk. Creditworthiness assessment. Assessing borrowers' creditworthiness is a vital stage in credit risk management. It entails assessing their ability and willingness to repay loans by examining their financial documents, credit scores, payment history, and other pertinent indicators. Credit rating agencies are important in evaluating and assigning credit ratings to entities, which indicate their creditworthiness. Credit exposure. This refers to the possible financial loss incurred by an institution if a borrower defaults. The quantity of the loan or investment, as well as the terms and circumstances of the credit arrangement, determine credit exposure. Credit exposure must be monitored and controlled in order to limit possible losses and maintain a balanced credit portfolio. Concentration risk. Concentration risk occurs when a major amount of a credit institution's portfolio is exposed to a single industry, geographic region, or individual counterparty. Overexposure to a single sector or entity makes the institution more vulnerable to bad developments in that industry. Diversification and risk limitations are utilized to successfully manage concentration risk. Credit risk mitigation. Financial organizations use a variety of measures to reduce credit risk. Collateral requirements, loan covenants, credit insurance, credit derivatives, and risk transfer via securitization are examples of these. Credit risk reduction measures are an effective attempt to limit possible losses and protect the institution's capital. Credit monitoring and management. Credit risk management is a continual activity that necessitates close monitoring of borrowers and counterparties. Credit quality is routinely assessed, financial conditions are reviewed, and changes in borrowers' creditworthiness are tracked. Proactive risk management steps, such as loan restructuring or setting aside provisions for future losses, are enabled by timely recognition of deteriorating credit circumstances. Regulatory compliance. Financial institutions are subject to credit risk management legislation and norms. Minimum capital requirements, stress testing, and reporting standards are imposed by regulatory agencies to ensure institutions have appropriate buffers to absorb potential credit losses and maintain financial stability. Effective credit risk management entails a combination of stringent credit evaluation practices, sensible lending policies, portfolio diversification, and proactive monitoring and management. Organizations can improve their ability to identify, analyze, and mitigate potential credit-related losses by implementing comprehensive credit risk procedures, resulting in more sound and sustainable financial operations.